Hey everyone, hopefully having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, related to three different topics: wealth building, commodities, and/or financial topics. So let's dive in, let's take a look and see what people are sharing. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, I dive deeper into all these topics and subjects, looking for potential investment opportunities and sharing them with everyone in the community. We've got a special coupon code that is active, and you can see the discount values in the description link below. So coming on down, uh, this is Kevin. He says, how many people do you think knew about the Moody's debt downgrade decision? Do you think some serious insider money positioned for it? Do you think they are collecting their profits this morning? Well, the conspiracy theorist in me thinks so. Buy the rumor and sell the news. Words to live by, article below. This also can pertain to earnings releases. You can see companies come out with pretty solid earnings, and you might see a sell off in the stock. And some people might ask, well, they beat earnings. Why did the company sell off? Why did the stock price sell off? Some of it is you buy the rumor and you sell the news. And if the news doesn't bedazzle the investors, if it doesn't beat by enough percent, you can see a sell off during earnings. It depends what's baked in the cake from the psychology of the investors. If they expect a beat and they beat, but they don't beat by enough, well, then the stock may sell off. If they come out and they just rip it, then yeah, obviously the stock generally goes higher if they have a gigantic earnings beat. But it's also what kind of forecast the company gives ahead. So it's not just that they beat earnings, it also depends on what the company is forecasting in the future. So it's not just solely based off earnings, it's also based off of what the company may be projecting in the future. So they could beat earnings today, but maybe they come out with a projection and say, hey, you know what? It doesn't look too good out there. And they may be talking about the current quarter that they are um, providing services in or selling products in. And that can obviously have a large impact on the way that people view the company and their earnings in the short term. Generally, around earnings calls, you see tons of volatility in both directions, up or down. I'm not a big fan of earnings releases. I just like riding through things. I like the steady moves. I like seeing things that move on up over time. And commodities are a little bit tougher play. They're very volatile, unfortunately, and generally the commodity price is what causes that volatility. Joseph Brown says the main reason we're seeing a big regulatory push for crypto is to support the treasury market. And keep in mind that Tether, here's Tether, see this on the right hand side there? It says figure one, major foreign holders of US treasuries, billions, with Tether included for comparison. Tether is what backs a lot of Bitcoin. That provides the buying power behind Bitcoin. And you know what Tether's investing in? US treasuries. Think about that for a second. Do you think that they're trying to funnel in the herd and the sheep to go and buy Bitcoin so they can back it with Tether? And Tether's back there buying a whole bunch of US treasuries? Getting warmer. Here's silver. Obviously, I'm a big fan of silver. To the frustration of all those awaiting a dump to get long, they may be lucky, though experience has shown when so many are awaiting, it never happens. So we may or may not get a pullback in silver, guys. And I'm not waiting. I already went whole hog into this thing. I've been buying since 2018 in it. I knew this pattern could exist. What I saw was a downward breaking wedge pattern. You guys know I like my wedge patterns. And then it put in a double bottom, and I was buying the right-hand side of the double bottom. I was buying it as much as I could. What happens with a lot of people is they're not patient enough. This is a big pattern, and patience is required on big patterns like this. When this thing goes and when it breaks, I don't know if it will go up fast or if it will go and it'll just keep going and going and going like the Energizer Bunny, where we could see this go up for 30 or 40 years. That is a possibility. It could break out and do a gigantic move in the beginning too. Generally, when you break resistance levels, say we break this $50-ish level, we could see a big move, and then we could do a retest after it. It's kind of like the whole thing shifted. The psychology is broken of the consolidation pattern. I think it will 100% happen, and all you have to do is watch what yields do. If yields continue higher, you're going to see an exodus out of the bond market, which we are seeing, and we're seeing yields go higher. That money's going to go somewhere. It's looking for protection. It's looking for a safe investment. Gold is one of the things that will get some of the money flows. I also think silver, with time, will heat up as well. So this looks fantastic. Big cup and handle, 45-year pattern. Be patient here, guys. This is going to be a life-changing move, but it may take time. So it might take some patience. I'm riding this thing. Ray Dalio says the risk of U.S. Treasuries is even greater than what Moody's is saying. This risk is this pattern. They're interconnected. The 45-year pattern is by no happenstance, and this opinion ties into this pattern. The whole market knows it's a problem, and silver's going to rip. When exactly will we break out of the $50 an ounce range? I don't know that, but this is a great setup. A percent means 10% GDP growth through 10% inflation is doable. More taxes are on their way, and this is the most sinister of all taxes is inflation. When you create money out of thin air to pay the bills, the value of the dollar goes down, and the poor and middle class get hit with a higher cost of living. It is the most evil of all taxes, says Ron Paul. The reason that the lower classes, we'll call it, get hit more than the upper classes is because the lower classes don't own any assets. And when the dollar gets hit, you'll see asset valuations go up. So what have we seen as they've printed all this money over the past, say, 10, 15, 20 years? We're seeing asset valuations go up. Those asset valuations are across everything. The S&P 500, the NASDAQ, housing market. You'll see hard assets eventually will catch bids massively, like gold, silver, commodities. They'll start to go up here when the financial assets get hit with higher interest rates. The higher interest rates, the cutoff levels around 4.5% to 5%. The stock market goes up with interest rates, and they're correlated between 0 and 4.5%. At 4.5%, there's a cutoff point where they start to diverge. If interest rates continue to go higher above about 4.5%, the stock market will start to go down. They diverge. So think of it as the economy strengthening in the beginning, and people are still rosy about stocks. Financial assets is what I'll say. Once it hits critical levels, 4.5%, 5%, 4.5% is really where it's at. Then you see a divergence where stocks go down and interest rates continue higher. Chicken Genius, he says the same rhetoric, the same crap show. The last time the U.S. 10-year hit 4.5%, immediate policy response. They know that 4.5% is the line to hold in the sand. Besant said he will use buybacks. Fed Collins said we'll do whatever it takes. Today, the U.S. 10-year hit 4.5%. Immediate policy response. Hassett comes on, Besant comes on. There's no other way. Print. Nothing stops this train by every dip. They're going to hold interest rates down probably at about 4.5%, is what Chicken Genius is talking about. And we're seeing resistance at that 4.5. It is the Fed behind the scenes buying it, is my guess. 4.5%. Watch this level. If it breaches the 4.5% and it starts to run, basically what they're creating is a gigantic resistance wall. Eventually, they're going to have to buy all the bonds. That's going to put a lot of pressure on the currency. That's when people say nothing stops this train. It's inflationary. You know what the most inflationary sensitive assets are? Oil, platinum. Watch those things break those patterns and run. We're getting real close. This is an interesting chart. So he's got the U.S. global debt has consistently outpaced the U.S. 10-year Treasury rates. This trend persisted until 2020, when it culminated in a dramatic peak and subsequent collapse. The U.S. debt is now unsustainable relative to interest rates. Gold is the only safe haven now. A break below that blue neckline, we shall have a reckoning. I'm going to make a comment here. You guys have seen, if you're part of the website, you've seen a lot of my inverted shoulder head shoulders. This one is a regular shoulder head shoulder. You know what's the inverse of this? Oil. Oil equities. When this breaks down, oil equities and oil is going to rip because it's very inflationary. So what this is saying is that the debt has always outpaced the interest rate. Now the interest rate is going to start to outpace the debt. That's not a good thing. And some people will say, "Oh, that's going to be deflation." No, if they create money to either hold the interest rate down or pay the interest expense as the interest rate goes up, that money's flooding into the system. That's stimulative. Nothing stops this train. It's money coming into the system, and they can't stop it. If you stop it, the currency will die. It's the design of that currency system. You must continually pump the currency into the system for the currency to survive and to pay off the debts in the system. There's very little paper currencies circulating in the system in relationship to the debt in a fiat currency system, in a fractional reserve banking lending system. Gold Silver HQ said, just use the gold revaluation accounts and central banks' balance sheets. Set gold price at $100,000 an ounce and call it a day. And this is the news that came out. Breaking news. The European Central Bank is warning that gold markets could pose a threat to the Eurozone's financial stability in the event of geopolitical stress due to demand for physical settlement. Right on schedule here. Additionally, disruptions in the physical gold market could increase the risk of a squeeze, is what's coming out here. Get ready. Here's Mexico. So Mexico EWW is starting to rip to the upside, looking pretty solid for EWW. And there's a lot of emerging markets. You know why we're seeing positioning and moves in these? Weaker dollar. You know what they're front running? They're front running them holding the interest rates down and printing money to do it. The market understands what they're doing at the Federal Reserve and what the government of the United States is doing. They're not going to bring down printing. They're not going to bring down the deficits. So what people are doing is they're positioning away from the dollar. So you'll start to see emerging markets start to rip to the upside. These are the beginning. This is all the beginning of a very big bull market in commodities, precious metals, and emerging markets. Weaker dollar is going to push it. Institutional investors are stuck in recency bias. This is not a normal gold bull market, but a monetary reset. When will they get it? And this is professional investors say gold is overvalued. And that's some survey saying that gold's overvalued, but yeah, it's a reset. Market Sniper says 100% at the real Rick Rule. It says, notice the multitude of gold supply to near infinity. Stories designed to shake you out of long positions in gold. The nothing burger of CERN alchemy, another example. Stay the course. Uncle Rick is guiding you to the promised land. Stay the course means stay long in gold. Don't let these articles, don't let fake news get you to sell out of positions. You're going to have a lot of conviction in what this will do over the long term. And don't pay attention to some of this news. I think it is, in fact, fake. Here we go. ECB is warning of a gold short squeeze. This is additionally disruptions in the physical gold market could increase the risk of a squeeze. Notice that they have fake news coming out. They don't want you to be there. They want you to sell your gold and get some of this pressure off of them. They control the news, guys. Get ready for it. Alexander Stahl says, we're not really concerned about the deficit. There's a bipartisan agreement to do nothing about the deficit until we actually get to the crisis, Einhorn summarized. So, billionaire investor David Einhorn explains why gold will keep rising. And it's got nothing to do with inflation, but it does. He says gold's not about inflation. He says the billionaire investor says gold is rising on deficit fears, but deficits create inflation. I mean, it is about inflation and it is about deficits because if you have more deficits, you have more money in the system, which is inflation. His fund crushed the S&P 500 last quarter thanks to a big bet on gold, and he's made some wrong calls. Everyone does, but yeah, definitely. And he says I'd be happy if it went to 35 or 3,800. I'd be really unhappy if it went to 30,000 or 50,000. He says because they lost control of the market at that point. Company says Ben Graham always told me that in a treasury meltdown, you want to hide in Ponzi crap companies. Moody's assessment is right. No other major developed economy is under pressure to grow its GDP by nearly 5% simply to service its debt. None. This is the central pillar of the bearish case for the US dollar. Foreign exchange is a relative game, and the urgency for rate cuts in the US is significantly higher than in other developed nations. Some degree of yield curve control is likely to be implemented in his view, and I think we're getting that right now. So this is public debt net interest payments to GDP. Look at USA, way up there. That's a problem. That's a problem. Part-time trader says, I don't get every call right, but my hit rate has improved dramatically over the last 18 months. What's scary is that it's taken me about 8 years to get to the place where I can claim to be pretty good at this stuff. Yet there are huge numbers of people on here that clearly know very little, but are utterly convinced that they know where the market is heading. It's honestly scary and also a strong sign that we're at the end of a cycle. I've been looking at charts and trading and investing for, I'd say, about 20 years. And there's been times where I really dove into it. There's other times where I wasn't paying attention to the markets as much over the years. But the one thing that I'll say is it's not about getting these short-term market calls right. Where you make the big money is where you just buy really good companies, just sit in them, and you just don't worry about it. Most people, what they do with physical gold is they buy it and then they don't do anything with it. And it ends up being a really good investment because they just don't do anything with it. And they bought it when the tailwinds were behind it. And that the tailwind started in 2000. So when you find that the tailwinds are shifting and you find the investments where those tailwinds are at, you can buy them at the beginning and you just sit in them and you just wait. Everybody wants to be so busy. They want to trade. They want to put on hedges and think like they're doing something. That's not really how you make money, though. It's not Stanley Druckenmiller, not even Stanley Druckenmiller, but Peter Lynch, Jim Rogers, Warren Buffett, all these guys, they weren't putting hedges in place. They were just riding things, and they caught these big bull markets and rode the bull markets. Now, things are going to look a little bit more ugly with interest rates breaking that downtrend. So Warren Buffett and Peter Lynch as well, they rode the entire bull market in stocks. The stock bull market started when interest rates peaked. They started declining in 1982. Go look here. I'll pull it up for you guys. Go look at a long-term chart of the S&P 500 from 1982 onward. So if we could take a long-term view, I'll make it a little bit easier. 1982 is when it broke out right here. And they rode this all the way up. They rode through this, and then they rode it all the way up again. So they had one big commodity bull market. Now, what I think we're going to enter is a potential sideways action move where we get another commodity bull market at the end here. So this is the whole commodity, bull market deal. And the reason I say that is because commodities are cheap to financial assets. This is a chart showing the commodity bull markets. 1, 2, 3, and then I think 4 should be starting any second. I mean, we're in it. I should say wave 3 should start, where we really start to pull ahead. So a lot of these guys, they rode the tailwinds. They rode the tailwinds whether they knew it or not, but they rode it. And that's where they made a lot of the money. Most people won't like your investment idea until after it doubles. Totally agree with that. You could come out there and say, I think this is bottoming. No one's going to like it because they want to see and chase price performance. They can't build conviction beforehand, a lot of people. They need to use price as the justification to buy something. Here's Peter Lynch. Big companies don't have big stock moves. In certain markets, they perform well, but you'll get your biggest moves in smaller companies. And I think that's kind of obvious. Here's Kevin. He says, call me crazy, but for the short run, I like bonds better than general equities. As we approach 5% yields or better, the price to earnings need to drop significantly. Remember what I said about the 4.5% and Basent holding it? This is exactly, everyone knows when you get around 4.5 to 5%, that's when the market needs to drop and PEs need to come back down. Your risk-free return on yields at 5% has a big impact on net present value calculations for stocks in the market. So Moody's downgrade is so late to the game. The fact is the bonds will be paid with freshly printed cash. It's the dollar that will suffer over time. Totally agree. Only question is how much and when. There's serious trouble brewing with the yields rising. Totally agree. Totally agree. And that's why they're going to get in there and hold it at 4.5%. They don't want to get into that trouble. So watch yields. Watch if it goes well above 4.5% and look to see if they respond. Another one from Tavi. He says, we are building a house before laying the foundation. Robotics may help address the labor shortage, but there's no strategy in place to ensure sufficient above-ground metals to support these initiatives. Yeah, the above-ground metals and inventories are getting pretty tight in copper and a bunch of other metals. Correct. It's your commodity bull market coming. I thought this was really interesting. It says a kilo of silver trades for about $1,100 an ounce, or $1,100 for a kilo of silver. Melt it into bullion rounds, and it's worth $1,300. Shape it into jewelry, and its value climbs to $4,000. Refine it into precision electrical contacts, and it reaches $15,000. But engineer it into micro-scale components for satellites, medical devices, and quantum computers. And that same bar becomes worth $50,000 or more. Your true worth isn't defined by what you're made of, but by how you refine your talents and where you choose to apply them. And that is a kilogram of silver and the product values of that and the way that it's manipulated into certain things. I thought that was interesting. Here's Grady. He says, yes, Willem, and the system now has the task of reversing the negative nuclear public sell they have done for decades. The uranium miners ETF Uranium did 580% in its baby bull move. And the uranium bull market has a very, very long way to go still. And again, this is URA versus SPX, and we still haven't gotten the big move. He is saying that we're probably going to get a 15 times up move against the SPX to hit all-time highs if we were to do that move on the left-hand side, on the right-hand side. So he says, very probable enormous reverse symmetry move coming. The real fireworks will start above the red line, and we're not near that red line yet. We still have some ways to run. So I'm going to ride this thing, guys. I'm going to see this thing through. Now, a lot of people, they're going to get frustrated. They're going to get impatient. They're going to sell out of their position. That's not how you're going to play this move, in my opinion. The way to play this move is to get in and ride the big move. It's coming. If they hold the 4.5% line on interest rates, which I think they will, watch the dollar. The dollar is going to be the big move of this thing. Uranium is going to go higher. Oil's going higher. Copper, precious metals. Look at the gold market. The gold market's already taken off. That's our leader. Our leader's running. The rest will follow. It says this ratio chart shows that small, mid gold miners have broken out versus larger gold miners. This is what we want to see, as it means the more speculative, smaller stocks are starting to outperform the larger stocks. It means the market is buying more risk, which is bullish. And here we've got a little breakout going on just recently of GDXJ outperforming GDX. People are coming into the market and they're speculating a little bit more in the riskier stuff. It's coming. It's coming. This says not good. Why are personal injury attorneys the marginal bidder for roadside billboards in so many parts of the U.S.? Is the sector really so large? Look at this, guys. It says the cost and compensation paid in U.S. tort system reached over $529 billion in 2022, or over $4,200 per U.S. household. 2% of U.S. GDP also appears to have compounded meaningfully faster than GDP over the past decade. This is lawsuits? Really? I just thought this was interesting. Look at this thing go. My Lord. That's crazy to me. Here's another one. So Market Sniper says nobody buying long-term bonds at these prices but the Fed. Yet somehow everyone expects rate cuts, meaning even higher bond prices for the FRD to 100%, the Fed to own 100% to own the market. Debt valuations need a massive downside re-rating. This means a rate spike to the upside are actually required. Buy real estate, autos, and all other financially leveraged assets if this rate spike does occur. The stock market would also go down, and that's where they're holding the line at 4.5%. Watch that line. It's mostly hold, baby, hold in U.S. shale. Frac crews are down 15% nationwide and 20% in the Permian since January and still falling, Diamondback told investors. U.S. shale output is nearing peak as oil prices stagnate. It says low oil prices and economic uncertainty are causing U.S. oil production, particularly in shale basins, to plateau or decline earlier than anticipated. Major oil companies acknowledge the accelerated peak in U.S. oil output, with the Permian Basin being the last major area still showing growth potential. Forecasts for U.S. crude supply are being revised downward as the profitability of shale production is challenged by current oil prices. And that's where we're going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Use that special coupon code. And that's all I've got for today. So we'll catch you next time. This is Finding Value.